The first half of 2025 has been absolutely incredible for asymmetric investing. The asymmetric portfolio is up 31.5% so far. I'm going to put out a video early on Tuesday just reviewing what happened in the first half of the year. And also on Tuesday, I'm going to put out all of the stocks that I'm buying for July. I do this every single month. That's the way the portfolio is built. I buy stocks every month and I hold them long term. I'm looking for asymmetric opportunities, 10x potential with limited downside. And in this video, I'm going to give away one of the stocks that I'm going to buy this month. It's not a sexy company. It's not going to get a lot of headlines, but I think this is a company that could have 10x returns or more over the next decade. So let's dig into it. My name is Travis Hoyman. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you want more from me, check out Asymmetric Investing, my newsletter. There's a link on the screen and a link in the show notes. That's where you're going to get more deep dives. You're going to get my asymmetric portfolio, a lot of value there. I also want to thank this video sponsor, Fiscal AI. I'm going to use Fiscal AI throughout this video, and it's a tool I use constantly. It's got everything you need from financial statements to insider transactions to transcripts. But the best thing is their KPIs. These are the key performance indicators. They're going to tell you everything you need to know about a company. These are the things management is watching on a regular basis. Just really simple to use and very, very nice looking charts. If you go to fiscal.ai/ASYM, you can try that out for free. You can try the pro version. And if you like what you see, you'll get 15% off. This is a tool I pay for, so I'm putting my money where my mouth is. But let's dig right into the stock that I want to talk about today. That is Lyft. Again, this is not a company that's going to get a lot of attention from the market or from the media. They're the second place player in ride sharing. But there are a few things I love about Lyft and about their position in ride sharing. First of all, I think that we have clearly seen over the past 6 months even that autonomous vehicles are coming and they are coming rapidly. And there's going to be a lot of suppliers. This is not going to be a winner-take-all market. Tesla, I'm sorry, they are not going to be the only player in autonomy. There's going to be Tesla. There's going to be Mobileye. Pony AI may be acquired by Travis Kalanick and Uber. There's May Mobility. There's a dozen companies worldwide who are delivering on fully autonomous vehicles. And when that supply of autonomous vehicles is effectively commoditized, who is going to take value in the market? Who's going to take the value from autonomous driving? It's going to be the companies that are aggregating demand, that are pooling that demand together where you have one app that people are choosing to interact with to get rides, to get food delivered. All of the things that we use Uber and Lyft for today. Now, I own both of these stocks, but Lyft is the one that I want to highlight today. I'll explain why in just a second, but let's start with the company's balance sheet. Now, Lyft has about a $6.6 billion market cap as I'm recording today. And look at this balance sheet, $2.2 billion worth of cash. This may come down a little bit because they acquired a company called Free Now recently. So that will take a little bit, and they are actually going to pay down or have already paid down about $400 million worth of debt. So this debt number is actually going to come down because that was due in May. But in total, you're looking at about $1 billion in net cash on the balance sheet, even after all of those actions have been taken. So I don't usually start with balance sheets, but I want to take the limited downside part of asymmetric investing and really highlight that with Lyft. The other thing you're getting is a great value. The enterprise value to sales is 1. The forward price to earnings multiple is just 13.5 on a trailing basis, a little bit higher, but I think this is a good proxy for kind of the valuation long-term. Price of free cash flow is just 7.2. If we flip over to Uber, you can see that the valuation is about 4 times higher. 4.2 enterprise value to sales multiple, price to earnings multiple is about 32. So yes, Lyft is the second place player in the market, but I think Lyft is being operated very efficiently today, and you're getting a much, much better value for the stock. So you not only have the growth potential of the company, you also have the potential for multiple expansion. Remember, there are really 4 things that drive stocks higher: revenue growth, margin expansion, multiple expansion, and then stock buybacks. On the revenue growth side, you can see that the compound annual growth rate is about 19% since the middle of 2022. So just phenomenal growth and just steady growth in double digits for Lyft. And then I mentioned those key performance indicators. How many riders are there on the platform? And is that growing? Yes, the numbers of riders is growing consistently about 8% on a compound annual growth basis. The number of rides increasing a little over 17% and gross bookings up about 15%. So these are all the drivers of the business. The other thing that has changed in ride sharing over the past couple of years is the take rate. Basically the percentage that these ride sharing companies, Uber and Lyft, take out of what you spend on each ride. The gross booking is going to be what you pay. Their net revenue is going to be the portion that they keep and doesn't actually go to the driver. That's why there's a difference between those two numbers, gross bookings and revenue. But that take rate has increased. Now, I don't think there's a lot more room for them to increase that take rate, at least yet. We'll get to autonomous vehicles in just a second. But the metrics that we want are moving higher and steadily moving higher. Margins are also improving, especially the operating margin. So you can see that this has steadily gotten better since 2022. That's really when the current management team took over. So these operating margins going up, the reason that they're still negative is they do have positive free cash flow, but things like stock-based compensation, which is a non-cash cost, comes out of the operating expense line. So I think we're on a path to profitability. And if you look at management's guidance for the second quarter of 2025, things should be getting even better. Double-digit gross booking growth, adjusted EBITDA expected to be $115 to $130 million. So again, that profitability is getting better. The value looks really solid. And adjusted EBITDA margin, 2.6 to 2.8%. So revenue growth looks good. Margin expansion is moving along slowly. And then there's that buyback. Remember I said that buybacks can help drive a stock higher. The reason for that is if you simply reduce the number of shares outstanding, you're going to reduce the number of shares that the profitability of a company has to be shared with. So the earnings per share is going to go up as the number of shares goes down. And what you want to see is management buying stock back when the stock is cheap, when the price to earnings multiple is 10, 11, 12. So when this was announced, the price to earnings multiple on a forward basis was about 11. Right now it's about 13, but they said that they're going to buy back $750 million worth of stock, so over 10% of what's currently outstanding. And their acceleration was to deploy $500 million of that in the next 12 months and $200 million in just the next 3 months. So by the time we get the next quarterly report, there's going to be 3-4% of Lyft's shares outstanding will have already been bought back. All of these things are what you want to see from a company that has high potential, that has asymmetric potential in the market. But this doesn't really highlight what the real 10x opportunity is. That 10x opportunity is in autonomy. And Lyft put out this slide. They did this in a blog post a couple of months ago. And I think this is the best explanation of the way that I see the autonomous vehicle market playing out. So you have a few different pieces of the supply chain. You have self-driving technology. There are a number of companies developing this. Some of them may license that technology to other auto manufacturers. Then you have the actual vehicle manufacturing itself. Sometimes that's vertically integrated with the technology, sometimes it's not. Then in the fleet business, you have who is owning the vehicles and who is financing the vehicles. This may be very different than what we have today in Uber and Lyft, where individuals are owning and buying those vehicles. That may move more to fleet companies, a little bit like the taxi business today. And then you have fleet management. Who is running the fleet? Who is actually charging those electric vehicles? Who's making sure they're clean? Somebody's got to do that work on a day-to-day basis. So this would be a little bit like a REIT. This would be a little bit like a management company, if you want to use housing or real estate as a little bit of an example there. And then you have the mobility platform and marketplace and the rider demand experience. So the marketplace is going to be connecting drivers with riders. The rider demand and experience is going to be the actual app that you're interacting with. This is where Lyft operates. This is the business that you know today. What's interesting about Lyft is they also have a subsidiary called FlexDrive. FlexDrive is a fleet solution. So you can build a fleet and use FlexDrive to help operate that fleet. Complete car care, vehicle lifecycle management, roadside assistant, visibility, what's going on with that vehicle. This is the kind of technology and the kind of interface that fleet owners are going to need for autonomous vehicles. If you're going to start a small business and own 10 or 20 autonomous vehicles and put them on Lyft or on Uber, you have to manage those vehicles. You're going to want to know what their operating maintenance looks like, what their ROI looks like. All of that stuff can be done by FlexDrive. They can maintain the vehicles. They can clean the vehicles. They can charge vehicles. This is a really key piece of the ecosystem that's going to be built out for autonomy. And I think this is where the upside for Lyft is potentially even higher than it is for a company like Uber. Think about the way that ride sharing works today. The market is really dominated by who has the most supply. If you open an app, you want to have a ride that's going to pick you up relatively quickly. Uber has the most drivers. Therefore, they're going to attract the most riders. What could change in autonomy? Well, if Lyft burns the boats and says, you know what, in your city, we're going to stop having human drivers and we're only going to go to autonomous vehicles. They could flood the market with supply. They could say, you know what, we're not going to operate a dozen autonomous vehicles. We're going to operate 1,000 autonomous vehicles in your city. And we're even going to change our pricing. So we're going to underprice the competition. Remember, those autonomous vehicles can operate almost 24/7. We've seen that the average Waymo vehicle does about 24 rides per day. The average human isn't doing that many rides per day. So the utilization is going to be much, much higher. Could change the economics. And Lyft has a better ability to change to that business model than Uber does. Uber just simply has more scale. So when we look at those two companies, like I said, I own both of them in the asymmetric portfolio. But the reason that I'm excited about Lyft is because it's a much better value, trading for about a quarter of the price of Uber. And I think the transition to autonomy is much clearer for Lyft than it is for Uber. You also have the FreeNow acquisition that they recently acquired. That's actually a taxi company in Europe. Again, if we look forward to autonomy, those are going to be fleet operators. That's going to be the same counterparties that a company like FreeNow has today. You could see that transition to being autonomous vehicle owners in the future. So you add all of this up, the valuation, the balance sheet, the profitability, the free cash flow, the buybacks, the upside in autonomy, flex drive. All of this makes Lyft a perfect asymmetric investing stock. There is limited downside in the stock. At worst, I could lose what I invest in the stock, but I think there's a lot of downside protection just given that solid balance sheet. But the upside potential, if they are successful in building out their autonomous fleet and being very aggressive with that, is easily 10x, if not even more than that. I think autonomous vehicles could grow the ride-sharing market by 10x. Even if Lyft just maintains its market share, this could be a phenomenal investment. But if they eat away at Uber's market share or any other company's market share in that business, that's where you get phenomenal upside. This is a stock that trades for $15.72 as I'm recording today. A decade from now, I wouldn't be surprised if Lyft trades for $200-$300 per share. That's the kind of potential that I see with this company. Their management team has the right vision. They have been executing phenomenally well, and the market just doesn't seem to realize it yet. But let me know what you think about Lyft. And of course, subscribe to Asymmetric Investing. Like I said, I'm going to do a first half of the year in review here on YouTube. And then all of my buys for July are going to go out to the newsletter before I make them on Tuesday morning, July 1st, 2025. If you're interested in what I'm buying for that portfolio, check that out. Lyft will be one of the stocks, but there are a few others that I'm interested in right now. Let me know your thoughts in the comments section below. Thanks for watching, everybody. We'll see you here next time.